Ago, Eric Jackson told us he's betting on growth stocks right now. However, our next guest says not so fast. She's Cameron Dawson of NewEdge, joins me right here at Post 9. You heard Eric, I hope, make the case as to, look, you might not time it perfectly, but a lot of these things have come down too much. First in, first out, why not now?
Well, they have come down a fair amount, but we think valuation is still a risk for growth stocks. They're still trading at 24 times forward earnings. Now, that's down from the 27 times that they peaked at back earlier in August, but 24 times is still expensive, mostly in the context of this liquidity environment. Given the fact that 10-year real yields are now at 75 basis points, that's more consistent with growth stocks trading near 21 times, which implies more valuation depression that needs to happen.
Implies also that you think rates are going to continue to go up. I mean, you've been maintaining the Fed is going to be more hawkish and have more resolve, I think, than some people have thought.
Yeah, and the Fed is telling us that it's not just about getting to the point of restrictive policy, it's about keeping it there. The Fed is afraid that if they do an about-face and start adding liquidity to this market, that they will reignite inflation. They talked about that at Jackson Hole. They do not want to repeat the stop-go policy of the 70s that saw that flip-flop and saw inflation cemented.
What if they can stop, though, if inflation starts, or at least continue, I think you can say continues, to trend in the right direction? Maybe they don't have to go as far, nor would they potentially have to cut because they haven't gone so far as to put the economy into nosedive.
Yeah, I think that's a really good point, which is what Powell was trying to say back in July. He was saying we want to get to the point of restrictive, but we don't want to go so far that things get out of control because we know that monetary policy acts with a lag. So then how does the market respond in that environment, I think, is the important point, which is that it's likely then that you would see the focus turn to earnings, meaning that valuations are driven by liquidity. They're driven by Fed policy. If the Fed's not easing policy, valuations can't sustainably rebound. Then we focus on the earnings story in order to get a sense of where markets can go.
Okay, so how inflated, if we want to use that word, are earnings projections now? I mean, how much do they need to come down? Because estimates are kind of all over the place, depending on who you talk to. What's your best guess on how too high they are?
Well, so if we think about where they stand today for 2023, $244 a share. I think your prior guest, Adam Parker, has them at $215 per share. If we take that 244 as what the market is expecting and compare it to other tightening cycles, that's implying 8% growth next year. If we look at past tightening cycles, 2015, we had down 2%. 2019, we had up 1%. 8% is too high in a tightening cycle. Of course, there are a lot of idiosyncratic things that happened those years, but the reality is that it's likely that we need to get closer to the low single digits, which is much more realistic and consistent with a tightening cycle.
Okay, so assuming that happens, you must be, if you're expecting that to happen, you must be anticipating the market going a fair amount lower from here. The question is how much lower?
Well, we thought that it's likely that now, given the fact that we have rolled over so hard at the 200-day moving average, that a retest of the June lows is in play. Now, we did see good momentum and breadth coming out of those June lows, and so we try to stay very balanced to say, look, the likelihood of us plumbing down to 3,200, 3,400 is less likely today. And so as we move through this process of recalibrating earnings, it doesn't necessarily mean a collapse in the S&P 500, but it certainly means that we likely will retest back to those 3,600 levels. And at that point, you'll have set a low bar. Valuations likely look more attractive. And I think that we can probably talk more about being opportunistic buyers.
Are you watching the 3,900 level closely on the S&P? Because I know a lot of other people are. And if you hold that, that's it's hard to say bullish sign in this sort of environment, but certainly better than what the alternative is.
It is the battleground. It was resistance and support. And anytime you have these places where you have a lot of consolidation of resistance and support, we're going to see a lot of fighting to see where we push either above or below it. If we hold 3,900, that is a bullish signal. So that means that the market is sniffing out some change in liquidity, willing to put a higher multiple on things on a sustainable basis. So even if the earnings start coming down, then the market will start saying, hey, we think that we're actually going to see that Fed pivot.
What are we doing? I'm sorry, finish your thought.
But if we don't, then I think that 3,600 is in play in short order.